everybody. Welcome to Friday, another Talk Money with Tom show today. Really excited to be able to help you with your retirement. We do that by answering your questions. Retirement planning, how do you manage money, different types of tax strategies you might use in your retirement. You can send those questions in now during the week to our email address at asktom@talkmoneywithtom.com, or you can post your questions in the chat here live on the channel, and we can try to answer those live also. So go ahead and send in your questions, and we'll start working on them. Secondly, of course, we believe very much so that the more you know about these areas, the better you'll do, at least financially, in your retirement, even if you have an advisor. So we created this channel. We put out tons of content on all kinds of different areas. We talk about the market every day. I do a summary at the show about the market and such too, so you can subscribe to the channel. You can hit the bell button and get notified when we get new content. If you really like to up your education, you can talk to us directly and we can answer your questions. You can go to our website. There's a book appointment button up in the corner, and basically it looks just like that, the little yellow button. Our schedule is live on the internet there, and you can pick a time to meet with Ethan and I, 30 minutes. Want to come in the office, fine, phone, video, whatever works best for you. So look forward to being able to help you today. We've got some good questions that have come in. We always use questions also that come up during our client strategy sessions that we have during the week. A lot of times there are things that might apply to more than just one client. So I look forward to being able to help you with that. We start off every show with a summary of kind of what we saw happening in the stock market this week, and I'll share the chart. And what we have here is the chart going back to 2021. You can see the big run up that we had and then the drop and what have you, but we just keep going. You know, it's just amazing. And that run that we're on started on the day of our show, with the low point in October 27th. And I still think it's amazing, because the one thing that just keeps jumping out at me was that we presented the report from Bank of America about the big institutions, the mutual funds and pensions and hedge funds, and their survey that they do. And they had the lowest exposure to the stock market for the last 72 years, pretty much at the wrong time in the end. But it's also what's fueling this, right? I actually just read this week that there's $6 trillion in money markets and those types of things that individual consumers have put in, and it actually grew $1.5 trillion. And so basically, as rates came up and the market wasn't doing well, people were moving into money markets, which made sense to a certain degree. Obviously, it was a mistake in the hindsight, right? Because we've had this huge run up. And so I think what we're seeing here is this kind of money coming back in, and this fear of missing out and what have you. And the power is there. There can still be some hiccups. So this week, we had a 1.6% down day on Wednesday. It was the day that the Federal Reserve came out, and the night before, Microsoft and Google had both reported their earnings and revenues. They crushed both of those numbers, but some of their forward guidance was a little bit soft. More importantly, the market seemed to be looking internally at Microsoft's AI revenue and Google's ad revenue, and they weren't as excited about the growth there. I don't know. I think it was sort of one of those days where the market was in a bad mood in general, and so those stocks got sold off a little bit. And versus what happened last night, right? Last night we've got Meta, right, who reported. Look at that. It's up 21 point something percent, and it's actually, because it's already a big stock, they're possibly going to have the biggest one-day move in market capitalization in history. Which is kind of incredible. So they reported last night. Market's obviously in a better mood. They said the right things, talked about AI. That's a hot subject to talk about, certainly, and whatnot, too. And so look at that motion. Again, this is going back to 2021 also. Had the big drop and some big, bad times, but really moving up nicely.
Yeah, billions of dollars were created basically overnight.
Yeah. What was it? Zuckerberg, maybe $14 billion of growth today. Something like that,
he basically
right?
made $14 billion overnight.
That's pretty incredible. So that obviously he lost a lot too in that downturn. He had to suffer through some of those things. And the other one that reported last night was Amazon. They're up a little over 8% today. But again, if you look at that, it's still a pretty big move, right? I mean, individual stocks move more than the overall market in general. There's more volatility, but that's a pretty good move. And so the thing that struck me was that yesterday when I was doing the video for the daily, video that I do for the market, I was talking about, the good earnings that came from this, and I was wondering if they were going to continue to go, and if it would drive the market, right?
Yeah.
Because usually it would. And so the market is up over 1.3% today. But the thing that I was worried about was that today in the morning, before the market opens, they report the jobs.
Yeah.
Right, for last month.
And the thing to remember is that Amazon Meta make up 5% of the actual market weight cap of the S&P 500, so they have a big push.
Yeah, so I mean that's one of the nice things about owning the indexes, right? We don't own Amazon directly, we don't own Meta directly. We'd make more money potentially, right? Because it's up 20% instead of being up 1.4-ish on the S&P. However, we also wouldn't have, I think Meta had one day after an earnings report, or one short period where it dropped like 40%, I believe in 2022. So, that's why we don't do individual stocks. It kind of goes both ways. But these are big stocks. They matter, especially for people that buy indexes like we do for the most part, or at least market cap weighted investments, which just means that these big companies have more impact as far as that goes. But yeah, but the jobs report came out this morning, and I was afraid if it came out really high, the market would kind of sell off, and we'd lose whatever momentum was coming from these good earnings reports from Amazon and from Meta. But then the jobs report came out hot. It was 185,000 expected, and it was 353,000, I believe, was the actual number of jobs created in December, according to the Department of Labor. So normally, at least in the past, the market kind of sells off when it gets too high.
Yeah. Because
this is worry. It's like it's too hot. It's going to create inflation, and we're going to end up with the Federal Reserve either not lowering rates when we think, or even raising rates is what we used to worry about, right? But I've always had this contention, and maybe the market's finally catching on because the last two times we've had a hotter job report, the market hasn't sold off, is that the number one thing we have in this inflationary environment is a restriction of supply. The demand has grown and the supply can't keep up, because this week they announced that there was 9 million open jobs, which was higher than expected. It was 8.7, right? 9 million open jobs, and it was 11.4 at one point, the highest point. So it's down from that. But if you look back historically, I think the average is around 4 million open jobs over the last 15 years. So there's a lot of job openings. And what happens is that these companies are putting out these, job postings because they have demand.
Yeah.
Right? I mean, they wouldn't be doing it otherwise. And so they're trying to meet that demand. And if they can't meet that demand, then it starts to become competitive, or we're going to hire people, we're going to pay more. That is an inflationary spiral. When you see a whole bunch of people taking jobs, that changes that dynamic, right? And it starts to create more supply, because the bigger restrictions that we're having aren't in the goods area like we were during the pandemic. It is in the services area, which takes people. So I think more jobs taken, and basically 353,000 jobs were taken, the better. And it does a couple things. Number one is it kicks even farther down the road, again, the concept of recession.
Yeah. Right?
Even the concept of soft landing is starting to be challenged now. They're starting to talk about no landing. The market's the economy's going to continue to roll. And so I think that, again, you look at the second half of last year, gross domestic product at 4.1%, inflation on core inflation with PCE dropped fairly consistently all the way through the second half of last year, and unemployment is at 3.7%. I mean, some of these are lagging indicators, right? So got to be careful with that. But the stock market is not a lagging indicator. So if we go back to looking at the S&P 500 here, look, I mean, the market is telling us that things are going to be okay economically. And the thing I look at, the Federal Reserve has about a 3 to 18 month period before their changes have impact, right? On average. It's a little soft number, to be honest. It's hard to tell some of these things, but the stock market is about 3 to 18 months ahead, right? So the market is expecting rate cuts, right? Or was. And if you look at it, the stock market is saying why. I would be looking, if I was the Federal Reserve, at one of the indicators, of course, something like the S&P 500, which is in the leading economic indicator. Yep. When it starts to soften, right, go sideways, starts to fall, that would be some time period where I might consider cutting rates, because of the fact that it's roughly the same time frame. It's saying 3 to 18 months from now things are going to slow down. I got to do impact, rate cuts, which take 3 to 18 months to have an impact. Some of these numbers don't match up perfectly, but you get the idea. So looking at some of the things that are lagging indicators, you have to be careful with. But overall, unbelievable, really. I mean, the market continues to go up, and the thing is that, and I've said this a couple times, I'll say it again, the best run, 5-year run in the history of the stock market was the .com, 1995 to 2000. We have artificial intelligence now, very, very similar to me, right? I mean, has huge potential impact, probably going to be really crazy stupid for a while about it, and companies that shouldn't be running will be running, just the same thing. It always happens. I talked about Detroit in the 1900s. It was 2,000 car manufacturing. Anything that's the hot thing goes nuts for a while. It's sort of that tulip mania. And so you do have to be a little careful with that eventual washout, but it can rise the whole market dramatically. Yep. The second best, 5-year time frame in the history of stock market was the Roaring '20s that came after a pandemic, right? We have both. Yeah. So I'm not saying it's going to continue to go forever, but you'd be surprised how far these things can go. I've been through this before. So, taking profits when things are still flying upwards, I probably wouldn't at this point.
Yeah, and with AI, it's still early days. You're not seeing a lot of IPOs with AI like you did with the .coms. You're not seeing all these small companies coming out. It's largely the big, large companies are still there.
Yeah, but if it follows pattern, we will. Maybe 6 to 12 months from now, we'll start to see some of these .coms. Usually it starts off with the legitimate ones. And then if we look at the .com scenario, it gets into the, bingo.com. That told that story a few times. That's when you know you're getting towards the top, right? So anyway, it's an interesting time period, and you have to be kind of aware of what's going on with all the money on the sidelines. The Federal Reserve, stopping raising rates, at least potentially lowering rates. Combined with artificial intelligence and a pent-up demand from the pandemic, it's a crazy time frame. So it's something to really watch for here, and I think it could be a good thing as far as that goes. But if we look at kind of what has happened here with the jobs report, just historically, I mean, this is a pretty interesting report. It goes back to 2020. You see that big red? That was actually a huge number of jobs lost, during that quarter for the pandemic, for the first quarter. And it took a long time to recover from that, certainly. And you can kind of still see unemployment was up there in that 8% range, back then, and it dropped down to actually 3.4%, right, which was kind of a historic low. I think it tied a historic low prior to the pandemic. We were roughly around the same spot.
Yeah, anything sub 4 is Fed's quite happy with that.
Yes, yeah, they consider full employment at 4%, right? So 4% of the population is, on unemployment at any one point in time or less. They're not going to worry about that as far as that goes. That's kind of how it works. Whether that's good or bad, it depends on whether you're employed or unemployed as to how you look at that, obviously. But, and this is broad. This is across the whole U.S. There could be sectors that are doing quite poorly and sectors that are really, really hot, right? That's
yeah, like if you looked at the actual breakdown of the jobs report, mining and logging actually lost jobs during this period. Yeah. So you could have an industry that's kind of in a small recession in a sense.
Yeah, exactly right. And because of the pandemic and the way that we shifted, we went from, hey, we just generally, before pandemic, normal spending to, hey, we're buying goods because we can't do services at all. And now we bought all the goods we want, and we're seeing kind of softness in the goods area, and we're going to do service things that we couldn't do before.
We're starting to actually see a resurgence in the manufacturing. Manufacturing and construction both were hiring, and their kind of productivity indexes are up.
Yeah, we saw the manufacturing report that came out this week showed more strength than we've seen in the last 3 years. So that's starting to pick up, and I think that's what's going to happen, right? We're going to even back out. we all went to Home Depot and bought things for our home, and we don't maybe need as many now, but slowly but surely we'll probably be going back to do that, because things wear out, new things and what have you. So you have a lot of job growth. You have growth of wages that are going faster than the core, inflation rates right now. That's got to make people feel good. We are seeing some really big upticks in consumer surveys.
Yeah.
I don't put a lot of emphasis on consumer surveys because I've seen them go very negative and they still spend money. It's kind of funny. So I really look at the spending because that's the actual thing that matters, not, what they say at a survey. But the surveys are really, really picking up. So I guess that's hopeful, right?
Yeah.
And people are looking at that. Let's look at what's happening in terms of the rates. For the, it looks like we're kind of in the way of this, but I'll read it. I'm sorry about that. But so a month ago for the March meeting, it was 79% chance of a rate cut, right? 1 month ago. Now it is a 21% chance.
Yeah, it's basically flip-flopped.
Yeah, exactly. Almost exactly. And so what the market was anticipating, things softening, slowing down. Again, you raise rates this much, something breaks, things slow down, what have you. That's not happening, right?
Yeah.
And so the Fed has been pushing back against this March one quite a bit, and it looks like the market's capitulated. We had some rockiness as that we went through that, but I think the takeaway here is that we don't need to worry quite as much about what the market thinks versus what the Fed's going to do up to a point.
Yeah.
Right? If the Fed is continuing to, really keep rates going when there's a lot of evidence that they shouldn't, we're seeing the stock market come down and we're seeing all these things, that's when we got to worry about the Fed going too far. I will say this Fed seems to get an inertia, right? So they had rates at zero, they were buying all these bonds, and lots of people were saying they should stop, they should raise rates because inflation started to come in really hard. And they actually kept going, and they really took a long time. They first stopped buying the bonds, and then they started raising rates, but it was like a 6-month period, and inflation continued to run. And the fear is that they would do the same thing on the other side, right, where they keep rates up too long and cause problems from that. So just one more slide here on what's happening. So the rates for May 1st would be the meeting after the March meeting, it was a 92% chance that there was going to be a rate cut by May. Okay, so it was, if it wasn't going to happen in March, it's going to happen in May for sure. That has now dropped down to a 72% chance.
Yeah.
So still pretty high, but I wouldn't be surprised to see that deteriorate like in flip-flop like March has. The Fed has been pretty steadfast in their interviews talking about doing rate cuts in that kind of June through September timeframe.
Yeah.
So we'll see. May's a long ways off in the world of economic data.
Yeah,
right?
We got so many months of just inflation, jobs.
Yeah, we've got the PCE reports that'll come out, right? The jobs reports, the factory order, all these things that they'll look at. The S&P 500 and what is it doing? Those types of things too. But I did think again, one of the things that I thought was a theme for this particular Fed meetings coming up here, they're not being as aggressive in their conversations or interviews or question and answer periods or what have you about trying to push the market down. Honestly, prior to November of 2021, I'd never heard a Fed be as aggressive against the markets as they were. They were trying to talk down the markets, trying to talk the bond market to going up into higher rates, partly so they probably didn't have to do as much in terms of their rate changes. But now, I think they are fighting some deflationary potential pressures. If you take the last 3 months, of the PCE core, it was 1.5%.
Yep.
That's below where they want to be. So I think they're okay with letting things run. And I'll bet you they're pretty happy with this jobs report too, again, because, they have a dual mandate, 2% inflation and full employment, right? And so this helps that full employment portion, but also it kind of satisfies some of the supply. And they've talked about that in the question and answer too. So I don't know, this is a great time frame. It's really fun after all the maneuvers we've gone through over the last several years, even last year's 10% drop. The market is kind of a funny thing. Really the best place to be is in an even keel. But if you can't accomplish that, at least enjoy the good times, because that doesn't always happen. I get a lot of people that seem to really kind of lock in on the bad times, and then the good times they don't want to accept them because they're kind of protect themselves. But to become a better investor, you got to get in the middle. That's why we kind of present the positive a lot to try to get people into that. But right now it's pretty positive, so enjoy that, and just from a feeling standpoint, and be glad that you're in, because a lot of people aren't. There's $6 trillion sitting in money markets that shouldn't be there in hindsight, right? So it's nice to be in. So congratulations. So anyway, that's the summary for this week. Really enjoy going through this with everybody, and look forward to doing it again next week. All right, what do we have for our first questions?
What are the pros and cons of actively managed versus index ETFs?
Okay, so first of all, an ETF is an exchange-traded fund. It's a basket of securities. Could be stocks, bonds. Those would be the most common anyway. They have all kinds of different ones, but and so it's a big, number. It can be 30. It could be, 7,000. There's some place in between there in terms of the number. And they trade, though, like a stock. It's kind of fascinating because it's, you can see the quotes every second, essentially, and you can buy and sell them, by the minute. You can put stop losses, because we always had mutual funds before, right? And mutual funds were mostly actively managed up until Vanguard really got going with the indexes, where they got rid of a manager. So actively managed means there's a manager who is picking and choosing those things that are in the basket.
Yeah, essentially they have like an investment strategy or something like that, and then they pick and choose stocks to fall or investments to fall within that.
There's all kinds of different concepts. It could be growth and value. It could be niche things like, someday AI, right?
AI,
exist,
solar,
right?
It could
Solar,
be anything.
Right. So you might, maybe if I'm an actively managed solar manager, I'm really into that industry, and I'm looking at all the different parts of it, and choosing, and really, in a way, an index would have maybe all of those holdings.
Yeah.
And what would happen with an active manager is essentially, and this is one of the advantages of an active manager theoretically, is they would have some that they don't own.
Yeah,
right.
Some they don't like for certain reasons.
So let's say it's a solar index that we have, and it has, 150 stocks, and I'm an active manager and I have 50 stocks. That means I've chosen not to buy those other 100 because they don't meet my criteria, my screens, right? And so there's pros and cons to that. It's really kind of fascinating. So if you just look at kind of selection, can somebody do a great job of deciding which 50 out of those 150 to choose?
Yeah.
Right? So you can see track record and such. There's a school of thought that it's very difficult to do so if I just buy them all, right? Which is what you do with an index ETF, because you might be very surprised. I mean, Meta's a great example, to be honest, right now. I mean, there's a lot of people that didn't think Meta was going to come back at all for a while there. I mean, when they were selling that out at 40% drop and what have you. So, I don't know. If I was an active manager, I might have sold my Meta out of my S&P 500 pool and narrowed it down to these 100 stocks out of the S&P 500 that I really like. I'd have missed out on that 20% run today, right? So that's one of the pros and cons. How good are they at choosing those positions, and what do they leave out? We kind of, personally, what we do here is we have, 3/4 of our portfolio in broad index pieces. We try to buy everything, because we know how difficult it is to get which ones are right. And the other 1/4 of our stock or bond holdings are in these more targeted areas. We're riding these waves, and we're trying to capture some, some of the returns that might push us over and above the market, right? So that's how we do it. So now, one of the disadvantages of an index is, again, there's some stuff that's really bad just because it's in the index, right? And so, stocks that are struggling or have too much debt or have all kinds of problems or, what have you. I mean, 3M is a great example, right? 3M was it's up down about 67% from its high, and it's had some issues with, and that's in the S&P 500. I think it's in the Dow, right? I mean, and good company, probably going to do great long term. But an active manager might have gotten out of 3M for a while, right? And waited, not have to go through that downturn with them. They have some issues with some of their products and different things that are going on.
And so you're paying extra Essentially, with these actively managed ETFs, there's usually higher expense costs on ratios on them, and so you're going to pay a little bit extra for that expertise versus a broad market index. You're basically just paying what very little in cost.
Yeah, I mean, for example, with some of these broad market ETFs at Vanguard, you might pay 0.1% or less, right?
Yeah.
And with some of the actively managed ETFs, you might pay 1% or more. Depends on the ETF. And so that's a pretty big differential. It means the active manager has to overcome that difference just to break even with the index that you could buy yourself. And so, that's kind of like a parachute that's holding you back, so to speak, when you're trying to move forward. And so that's one of the big ones, is the differential in cost. However, personally, the way I would look at this, just in my own world, I don't really care about the cost if they're outperforming after that cost, right? Because it's the same. So if I'm paying 1% more, but it's producing 2% more, I'm ahead.
Yeah.
So the way we do it is we have, like, for our target things, not the core pieces, the big broad pieces, but for our target pieces, we have these big lists, maybe 180 ETFs. Some of them are actively managed. And so if they can move up to the top and go and show us that there's momentum behind there, I'll buy them, right? It often doesn't happen, which is interesting. We haven't seen a lot of those come into our portfolio, but.
Yeah, and there's also, another thing with actively managed is if you want to target like a certain idea or theme. So let's say I want to do, for example, I want to do biotech companies that have gotten FDA approval for their drug. Essentially, that's super niche. You're not going to have a broad market index to fit that. And so you can grab this ETF, you're going to pay a little bit more, but they're going to screen for those specific company.
Yeah, and again, if you pay more and make more, it still works. It's just, it's harder.
Yeah.
And so, yeah, exactly right. That niche concept where you really find something that you want to, pursue and put some money in. And so, yeah, that's kind of the differences as far as I'm concerned. I don't have any problem with either one of them. I know that there are some people that are really, really into indexed everything, and it's almost evil to talk about the other things, but return is return.
Yeah.
I have to be really brutal about that. I mean, our job is to get return, period. I mean, if we want to keep our job, we have to get return. If an active manager can do that over an index, I'm all for it, but they have to prove it, and they have to continue to prove it, because it's free for us, commission wise, to get out of these things. So that's kind of a, I don't have an allegiance to anything. You just got to perform. My job is to get the most I can for the risk level that each client has accepted. And it's really, wherever, I don't care where it is, as long as it fits within that risk level and it's moving.
Yeah.
At least for these target things that we use.
Yeah, if you're investing on your own, you want a simple strategy, broad market indexes are great. But if you're a little bit more advanced, do it yourself, or, targeted indexes could be helpful.
Yeah, nothing wrong with just doing broad indexes all by yourself, especially. I think that's the way to go. Matter of fact, I think, most people that don't have all day, every day like we do to spend working on it probably should be doing that, including Warren Buffett. That's his recommendation for the general public, buy the S&P 500 and buy these broad indexes. And, I don't think he's wrong at all in that category. Our job is a little different. We're trying to beat those indexes. And so that's, we've got a little bit, we want to make up our fee, right? So, that's a big one. All right. Good question.
What's the difference between momentum trading, buy and hold, and directional trading?
Momentum trading. Okay, so momentum trading is what we do. So that's pretty easy one for me to answer. So that's where something, the idea of momentum, right? Goes back to what Isaac Newton, is that who did that originally? A body in motion stays in motion, right? There's some friction eventually that slows that down and such too. But so it's the same concept. Once we find something that's in motion, we have different ways of finding those. We want to grab that, I call it a wave, and then ride that wave, right? Until that wave's, expires, and then you go back and find the next wave. So that's momentum investing in general, is you're just looking for those places where the money is going, right? And so, it's almost impossible to know every detail of why the money's going there, which is what a lot of people try to figure out. Why is this going to happen? Why is that going to happen? It's a lot easier to just see it happening, get in there, and write it. What isn't easy is to know when to get in there and when to get out of there,
Yeah.
right? And so how far do you write it? Do you get in too early and it's a false move? You get in too late and it's already over? That is the part we spent a lot of time doing back testing on to figure that out. So that's momentum. Buy and hold is a really good strategy. It would be my second strategy to choose personally. Buy and hold some indexes, right?
Yeah,
Broad market indexes.
If I was kind of like, I want to spend 20% of the time and get 80% of the value, buy and hold is great with just simple yearly or annual rebounds.
Yep, nothing wrong with that. I mean, if I didn't spend every day working on this, and just wanted to not have to work on it, buy and hold strategy, I would focus more on my savings, right?
Yeah.
Get some money in the stock market, get some money in the bond market, and save going forward. You'll be ahead of a lot of people. There's a lot of people are trying to really do all these crazy things. I get out there and I get a lot of informational interviews with different people that want to talk to us about, and they're into investing and they're doing some really, really aggressive investing and they're struggling, and it's like, well, yeah, I mean, you're trading currency options and, naked options and crazy stuff that, can work. And they've usually got some guru that's showing them how to do it in a lot of cases. But it's very difficult. So if you don't want to do that, buy and hold is definitely a really good strategy. And, figure out how to make more money somewhere else.
Yeah.
Right? And then save it and you'll do fine. So directional trading.
Directional trading is kind of it's kind of a mix in a sense of momentum and buy and hold. It's a little bit more long-term strategy. The idea is it follows the business cycle. So when the business cycle is going up, you're kind of buying and holding. And then when the business cycle changes over, you kind of shift your targets to depending on where you're at the business cycle. So like early in the business cycle, a lot of times it's going to be your large caps.
Yeah.
And so you're staying in large caps, but towards the end, it starts to more move to small cap. So maybe you make a over allocation into small cap.
Yeah. I mean, you look at the 2000 run up, and we've been talking about, .com versus AI, artificial intelligence, and some of the similarities there. So that's exactly what would happen here in this particular cycle. And so what is happening at the moment, right? So the big, large companies, and they're calling it the Magnificent Seven, and they got all these different names, that are running, including today, because Amazon's up 8 and Meta's up 22 or something like that. At least it was when we started the show. And so those are the beginning, and then eventually it'll start to, people they want more.
Yeah.
So they start to move down the ladder of capitalization, and to the point where we're starting to talk about micro caps and stuff. And when you get to that point, you probably are getting closer to the end, but you could shift your strategy just on a capitalization basis as these waves come through, and probably do pretty well, actually.
Yeah, and you may be like towards the end of the cycle start to switch to value if you start to see the end of the cycle is coming through.
Yeah, exactly. Or even, because I look back at what happened, in the 2020, 2021 run, and it did exactly that. Big stocks, Apple and Microsoft were great, because people were scared, pandemic. They wanted safety, they wanted cash flow, they wanted cash positions, low debt, etc. And then as things kind of developed and things got better and better, we got into this, more and more rarefied stocks, companies selling for 300 to 500 times earnings if they had earnings, right?
Yeah.
And the flip in 2021 would have been into the broad market, buying the total stock market index and what have you, and just kind of, because 21 kept going, but it didn't have that same pattern anymore. Matter of fact, the pattern in 2021 was completely scrambled. It was really incredible. But if you just would have been in the S&P 500 or something like that, you'd have done well. So it is one of the reasons why we keep three-quarters of our money in those broad indexes, because it's very, very difficult to see some of these changes. But with those targets, you could be moving from large to mid to small throughout that directional trading time frame. So you can make an argument for that.
What's a systematic withdrawal from an annuity? How does it work, and how does it affect the benefits?
Okay, so an annuity, you've got money in an annuity, and you want to get it out somehow, right? First of all, keep in mind that you shouldn't get it out up front because it does grow tax deferred. It is one of those vehicles that doesn't have a required distribution like your IRAs and 401ks. So those should stay, at least in the what we call the sequence of withdrawals.
Yeah.
Those become later in the sequence. So let's just assume you get to a spot where you really do need money out of that or want money out of that. The annuities themselves are designed, and the problem with this conversation is that every contract is actually specific.
Yeah.
It's not like, like an ETF is generally an ETF, right?
Yeah.
An annuity is, they can all be really different writers. And so let's talk generic, but be very careful with this conversation because generic might not apply to your annuity. But generically, there are a couple of main ways of getting money out of these things. Number one is to annuitize them,
Yep.
right? And so you can annuitize, and they'll give you a quote on how much you can get, depending on what term you pick. So if you pick what's called life only, which means it only goes for as long as you live,
Yep.
that's usually the highest payout, right? Now, if you have a spouse, they're out of luck. If you pass away before them, the money stops. If you have beneficiaries that care about that, they're out of luck too, the money stops. But you do get the most. Then you can get a joint life, where the money would still go to the spouse. Could be all the money or half the money. There's usually different choices. Yep. That's a lower payout. You could get it where you get what's called 10-year certain, 15-year certain, 20-year certain, where if you pass away within, let's say, a 20-year certain, your beneficiaries will get the rest of that 20-year period payout. Yeah. And usually that means, if you look at the numbers, you're going to get all the money back that's in that annuity. You might not make much interest on it, but you'll get it all back. And so that's actually a big deal to kind of analyze that and figure that out and figure out which one's the best for you. But the problem with an annuity, an annuitization of an annuity, is that they, in almost every case that I've seen, the principal is no longer available to you.
Yeah, is there some sort of death benefit or surrender value that completely disappears?
Yeah, let's say you have $500,000 in an annuity and you decide to annuitize it. They're going to give you a payment every month, depending on which option you chose. And then the money's the $500,000 is gone.
Yeah, in exchange for that payment,
Right.
they're taking that $500,000
Right.
value.
So if you need capital and you don't have anything else, it just disappeared. So not the greatest idea. So one of the options is that you can do what's called a systematic withdrawal. The annuity companies, in my opinion, really like the annuitization. I think because they know on an amortization basis, they're going to win that story across a large group of people, right? Yeah. That's the same thing with life insurance. So, however, a systematic withdrawal is available where you can just set up a withdrawal of a certain dollar amount every month.
And so, this is nice if you need more income than what the annuitization would provide. So you can go for higher amounts of money.
Right. Now, there's no guarantees, right? Because you can actually deplete that $500,000 down to zero and then you're done, right? Versus the annuitization, you're getting it for life or whatever the term period that you set up, you're going to get your money. And so some people like that annuitization. It's sort of like a pension, right?
Yeah, you can't outlive the annuitization. Right. So say you put in $500,000, you could get $1 million in payments out.
That's right. Yeah, if you live long enough and you kind of win the battle of amortization tables. Sorry, not amortization.
Annuitization.
They call it. It's actuarial table. Sorry.
Yeah.
Anyway, so systematic withdrawal has that disadvantage, but it has a huge advantage in that maybe your account grows, right? You can keep managing it. There's investments to pick from and what have you, and perhaps you can keep up with most of your withdrawal, and you can keep growing with that. Your beneficiaries get that lump sum, which they have to deal with, and there's tax issues and whatever. But let's say you need $100,000 for some big emergency, a big medical emergency that comes, you don't have it in another place. You could go into that annuity and pull that $100,000 out. It's going to be taxable, at least some of it maybe, if it has some growth. But you still have that liquidity. The money's still there. And so that's the biggest difference. And we do see systematic withdrawal being quite popular, actually, within the annuity world versus annuitization, at least from my experience.
And the idea is that you can also, if you need the money just for some sort of emergency, a prolonged care emergency, this is a way that you can pull out the money too without having a big tax burden with you when you surrender.
Yeah, exactly. So that's the difference between those. Annuities are very complex animals. I find them kind of interesting because of that. We end up analyzing a lot of different pieces. If you have some annuity questions, let us know. We'd be happy to look into that. And again, we can get into specifics about your contract because believe me, everyone, and even from, you can say, oh, I have a John Hancock annuity. Wow, there's like 1,000 different John Hancock annuities, because
even
every
each year, it could be like, it could be the same product and just to be a different year, right? It could have a totally different contract.
Yeah, it's like revisions that they keep making and adjustments that they make to those pieces. And so, you might have an income rider for life. That's a totally different deal. That's kind of in between annuitization and systematic withdrawal. Those are really popular. You got to analyze those. You got to look at the pros and cons of those. So if you have annuity questions, we can help you with those. Be happy to, give you an opinion on what you're dealing with. All right. So, all right, we got maybe time for one more quick question.
What's equal weight versus market capitalization?
Oh, yeah, that's a good one. So you have a basket of securities, stocks or bonds, right? Mostly this goes with stocks. And how do you decide how much to put in each stock?
Yeah.
Right? And so, if I'm an active manager, I'm deciding based on what I feel about each stock. Mm-hmm. If it's a passive index with no active manager, then they have different strategies. The most common is capitalization.
Yep.
So you take the number of shares outstanding for every company, you multiply it times the price, and that's the capitalization. And what Microsoft, I think, is just hit 3 trillion or just about to hit 3 trillion.
Yeah, they make about 7.25% of.
Yeah, I saw something today that Amazon just passed Google in the 4 comma club.
Yep.
So that's the $1 trillion capitalization or higher club, which I thought was kind of interesting. So anyway, so you would obviously see a higher concentration in those very big stocks. The S&P 500 is what, 25% in the top 10, give or take, I think, in terms of the exposure, because the S&P 500 is a capital weighted index. Mm-hmm. So one way that they do to kind of even that out and get more exposure to some of the other stocks that are in that index is what's called equal weight, and they would just say, okay, we're going to have 2% in every stock, or whatever it is. Divide the number of stocks into 100, and you get how much would go into every stock, and then that's actually rebalanced, usually quarterly or annually or something, so that those ones that kind of perk up a little bit and run, they're sold. The ones that did poorly are you're buying, and so you're kind of sell high, buy low on a regular basis. And equal weight does really well when the smaller stocks are doing well. Right now, equal weight is not doing well, versus market capitalization, because the Magnificent Seven, that everybody keeps talking about, is running really hard and is pushing all these indexes. And, if you're not in those, you're not participating in the market fully. But that will change, and we talked about different strategies, right? So that's one way to move your capitalization, is to look at equal weight also.
There's also a new one that I was saying is called revenue. So it's based on the actual company's revenue.
Yep.
And that one is like, instead of being as top heavy with like tech companies, it's kind of like Amazon and Walmart. You know, these companies that are having a lot of big amounts of revenue.
Yeah, exactly.
So there's different ways that you can kind of have the same holdings, but just have different weights.
Yeah, and it makes a big difference. You can have exactly the same holding. You take the S&P 500, it's diced and sliced a bunch of different ways.
Yep.
There's a revenue one. There is an ESG one where that's got a screen, so it doesn't have the same 500. But you've got the the capital weighted one, the equal weighted one, etc. And right now the capital weighted one is doing quite well compared to the others. As far as that goes. So anyway, that's good to know. It's important to understand how all of that works. The more you know about investing, the better chance you have of doing well, even if you have an advisor, in my opinion. So. All right. Well, that's our show for today. I really appreciate everybody coming today. Love the questions. Look forward to being able to, meet with you again next Friday. We'll be here live, and see you then. Thank you very much for coming today. Quickly, subscribe, right? Hit the bell button. Set up an appointment if you want to do an appointment with us, and we'd be happy to meet with you and 30 minutes here in the office, phone or video. Thank you very much.